Welcome to the deep dive. Today, we're looking at CoreWeave, the AI hyperscaler. They just released their Q2 2025 earnings. Huge revenue growth reported.
Huge. Off the charts, really.
But here's the kicker. The stock actually fell afterwards. So what is going on there?
Yeah, it's a bit of a head scratcher on the surface, isn't it? We're going to dig into those numbers today, try to connect the dots on why the market reacted that way.
Okay.
And, see what this all tells us about the bigger picture for AI infrastructure. It's a fascinating space.
Definitely. Okay, so let's unpack this, starting with the immediate stuff, the Q2 numbers.
Right.
What exactly did CoreWeave report for revenue?
Right. So the headline revenue number was $1.21 billion for the second quarter.
Okay.
And that actually beat Wall Street estimates. They were expecting something closer to $1.08 billion.
It's a solid beat then.
A solid beat, yeah. And I mean, the growth is just staggering. Revenue more than tripled. It's up 206% compared to the same quarter last year.
Wow, 206%.
Yeah, back then it was $395.4 million, so a massive leap. Now it's maybe a slightly smaller beat than Q1, percentage-wise, which maybe tempered expectations a tiny bit, but still.
Still, triple-digit growth is hard to argue with. But clearly the market did argue, or at least react negatively. So if revenue was strong, what about the bottom line? Profitability.
Yes, profitability. That's where things get, let's say, more nuanced. The company reported a net loss of $290.5 million.
Okay, a loss. But how does that compare?
Well, it's actually an improvement. A year ago, the loss was bigger, around $323 million. And the loss per share also got better, 60 cents this quarter versus $1.62 a year ago.
So losses are shrinking.
Oh,
It sounds like progress, right? Why the negative reaction then? Was it the operating margin?
exactly. You hit the nail on the head. The operating margin, well, it shrank a lot, down to just 2%.
It's 2%. From what?
From 20% a year ago.
Wow, okay, that's a huge drop. What drove that?
The main driver, according to the report, was about $145 million in stock-based compensation costs during the quarter.
Right, stock-based comp. So not necessarily cash going out the door, but it hits the official GAAP profit numbers hard.
Precisely. And remember, CoreWeave is still pretty new as a public company. Their IPO was only back in March. So these kinds of expenses, especially for attracting talent in the super hot AI field, can really make the official numbers look, well, less impressive, even if the core business is booming.
That makes sense. High growth, high talent costs. Okay, what about looking forward? Did they give any guidance for the next quarter or the rest of the year? Investors always want to know what's next.
They mentioned they'd provide forward-looking guidance on their earnings conference call, which happened after the initial report release.
Ah, okay, so the initial press release didn't have those forward numbers to maybe calm the market down immediately.
Seems that way. But, it's also important to look beyond just the standard GAAP numbers here.
How so?
Well, they also report non-GAAP figures like adjusted EBITDA, and that number looked pretty strong.
Okay, what was that?
Adjusted EBITDA was $753 million. That's way up from $249.8 million a year ago, and the margin on that was 62%.
62% adjusted margin versus the 2% GAAP operating margin. Big difference.
Huge difference. And adjusted operating income was $200 million. These adjusted figures, they strip out things like the stock-based comp and, importantly for CoreWeave, depreciation on all that hardware they're buying. So it gives you a potentially clearer view of the underlying operational health.
Got it. So a mixed picture on profitability depending on how you measure it. Let's shift gears a bit. Beyond the raw financials, what strategic moves are fueling this growth? What's driving the business forward?
Well, a really big piece is their relationship with OpenAI.
Right, the AI giant.
Exactly. OpenAI is a major client and also an investor. CoreWeave highlighted they expanded their business with them significantly. There was a $4 billion expansion deal just in Q2.
$4 billion, on top of what they already had.
Yeah, this builds on a previously announced deal that was already massive, like $11.9 billion. It just shows the sheer scale of demand coming from the top AI labs.
Incredible. Are they just focused on compute or expanding their offerings too? Any big moves there?
Oh, definitely expanding. They made a pretty significant acquisition during the quarter, bought a company called Weights and Biases.
Lace and Biases, I know them. They do MLOps, right?
Yeah.
Software for managing AI models.
That's the one. They paid about $1.4 billion for it, and they're already rolling out products based on that tech.
Like what?
Things like mission control for managing cluster health, WNB inference for using open source models, and something called WNB Weave online evaluations for checking AI agent performance in real time.
So they're moving up the stack, adding software and management tools on top of the raw infrastructure. Makes sense.
Exactly. It makes their offering stickier, more comprehensive than just renting out GPUs.
Okay, but they still need a ton of GPUs and power. How are they scaling the actual physical infrastructure to handle all this demand, especially with deals like the OpenAI one?
Yeah, the scale is just mind-boggling. They ended Q2 with about 470 megawatts of active power in their data centers.
Which is already a lot.
It is. But get this, they increased their total contracted power by another 600 megawatts or so. They now have contracts for a massive 2.2 gigawatts.
2.2 gigawatts. That's
Mm.
that's power plant territory.
It really is. And they're building, too. They've started work on their first big purpose-built AI data center campus from the ground up. It's in Kenilworth, New Jersey.
Okay. How big?
Planned for up to 250 megawatts, expected to come online in 2026. So massive investment in future capacity.
And are they keeping up on the technology front, using the latest and greatest hardware?
Seems like it. They were actually the first cloud provider to get NVIDIA's newest GB200 NVL72 systems running for customers at scale.
The Blackwell generation stuff.
Yep. And they backed that up with performance numbers, too. They submitted results to the MLPerf training benchmark using those GB200s. Their submission was apparently 34 times larger and 4.5 times faster than other submissions in that round.
So pushing the envelope on performance, not just capacity.
Yeah, they're aiming for technological leadership.
Okay, all this expansion and these huge client deals must mean they have a significant backlog of future revenue, right?
Oh, absolutely. Their revenue backlog stood at $30.1 billion at the end of June.
30 billion. With a B.
With a B, that's up 86% from $16.2 billion just a year ago, driven mainly by that big OpenAI deal we mentioned, and also a new contract with another major hyperscaler.
And that backlog is based on committed contracts.
That's the key. It represents future revenue they expect to recognize based on contracts already signed. It gives them visibility, but it also means they have to deliver.
Which brings us back to the cost. All this hardware, all these data centers. What did their capital expenditure look like? Must be huge.
Record-breaking for them. CapEx was $2.9 billion in Q2 alone, the highest ever for the company.
Almost $3 billion in spending in just 3 months. Wow, how are they funding that?
Well, alongside their operations, they raised debt. They successfully issued $2 billion in senior unsecured notes. The interest rate was 9.25% due in 2030. And interestingly, they actually increased the size of that offering because demand from investors was strong.
So even with the stock reaction, debt investors were still willing to lend them $2 billion, albeit at over 9%.
Right. Shows there's still confidence in the long-term plan, at least in the debt markets.
Okay, so let's circle back to the original puzzle. You've got incredible growth, huge deals, massive investment, technology leadership. Why, then, did the stock drop after earnings? What are the lingering concerns?
Well, if you try to connect the dots from an investor perspective, a few things likely stand out. One is customer concentration.
Meaning they rely too much on just a few big clients.
Potentially, yeah. I mean, their big clients are giants. Microsoft is their biggest, then Meta, OpenAI. You couldn't ask for better names, really.
True.
But having your fortunes tied so closely to a handful of customers, some investors see that as a risk. What if one of them cuts spending or decides to build more in-house? It could have a really big impact.
That's a classic risk factor. What else? You mentioned the debt earlier.
Yeah, the debt load is significant, around $11 billion in total debt now.
11 billion.
And while the adjusted profits look okay, the company is still reporting those GAAP net losses. So you have high debt and ongoing losses on the official books. That combination can make some investors nervous about financial sustainability, especially with interest rates where they are. That 9.25% on the new debt isn't cheap.
Right. It's a lot to carry while you're still trying to reach consistent profitability.
Exactly. And then there's a more immediate sort of technical factor hanging over the stock.
Coaches.
The IPO lockup period, it's set to expire late Thursday this week.
Ah, the lockup expiry. Explain that for listeners who might not know.
Sure. So after an IPO, there's usually a period, often like 180 days, where company insiders and early investors are locked up, meaning they can't sell their shares on the open market.
Okay.
When that period expires, suddenly a whole lot more shares can potentially be sold. This increases the float, the number of shares actually available for trading.
And more supply can mean downward pressure on the price.
That's the theory. Analysts were pointing to this expiry as a reason for potential pressure on CoreWeave stock this week. And you have to remember the context here.
What context?
CoreWeave stock had an absolutely insane run-up this year. Heading into the earnings, it was up something like 265% just in 2025.
265%. Wow.
Yeah, it hit an all-time high around $187 back in June. So some profit-taking wouldn't be surprising anyway. And the lockup expiry provides a clear window for early holders to potentially cash in some of those massive gains. Plus, the stock has been pretty volatile, partly because the float has been relatively small until now.
And didn't they also announce another big deal recently? An acquisition?
Oh, yeah, good point. In June, they announced they were acquiring Core Scientific. That's a big Bitcoin miner, also has data center infrastructure,
How much was that deal worth?
about $9 million, and it was an all-stock transaction. So that adds another layer of complexity to their finances and stock structure that the market is still digesting.
Okay, so summing it up, CoreWeave shows incredible revenue growth, signing massive deals with AI leaders, investing heavily in cutting-edge infrastructure. But
But the market seems focused on the shrinking gap margins, the high debt load needed to fuel that growth, and this imminent IPO lockup expiry possibly flooding the market with shares. Plus, that big Core Scientific deal adds more moving parts.
it's a real mix of enormous potential and significant financial pressures and market dynamics.
It really is. And this brings up a key question for you, the listener. When you look at a company like this, right at the heart of the AI boom, how do you balance that massive future promise against the current financial realities?
Yeah, how much debt is too much? How much dilution is acceptable for growth? Are those gap losses a temporary speed bump or a sign of deeper issues?
Exactly. It's the classic challenge of valuing high-growth, high-spend companies in a transformative industry.
So perhaps the big takeaway here is what CoreWeave's story tells us about the real costs, the billions in capex, the high interest rates, the stock compensation, and the potential long-term rewards of actually building the foundational infrastructure for this AI revolution.
Definitely something to think about as AI continues to change everything around us. It doesn't come cheap.
Indeed, lots to ponder there.